All right, let's talk about investing. For so long, it's felt like this exclusive club you needed a fortune to get into. But what if I told you that's just not true anymore? Today, we're going to show you how to take $1,000 or even way less and start building your future. Let's do this.
So let me just ask you this, right off the bat. Do you think investing is a game only for the rich? I mean, for a long time, you wouldn't have been wrong. But that world, it's pretty much gone. The rules have totally changed, and the doors are wide open for everyone now.
I mean, think about it. It wasn't that long ago that buying even one share of a popular company could cost you thousands of dollars. It was a huge barrier. But now, that wall has completely crumbled. Thanks to a few key innovations, you can literally start building a real, diversified portfolio with the money you'd spend on coffee. The game has absolutely changed.
Okay, look at this. This image right here holds probably the single most important idea for any new investor. It's called diversification. Just imagine a street vendor. On sunny days, they sell sunglasses. On rainy days, they sell umbrellas. No matter the weather, they're ready, right? They've lowered the risk of having a totally bad day. That simple idea, well, that's the foundation of a smart investment strategy.
So let's jump into our first section here. We're calling it Investing Isn't Just for Millionaires. We're going to dig into why the game has changed and look at the actual tools that have made it possible for pretty much anyone to get started. Now that we know this is for you, let's build your blueprint. Because before you put a single dollar into the market, you need a plan. And I'm not talking about chasing hot stock tips you see online. This is about understanding 3 core ideas that will guide every single decision you make from here on out. First up, asset allocation. Now listen, this sounds kind of jargony, but it's so important. Experts pretty much all agree that this one decision, how you divide your money between different things, is responsible for over 90% of your long-term results. It's not about picking the perfect stock. It's about having the right mix. Next is your time horizon. Honestly, this is your superpower, especially if you're younger. It's simply how much time you have before you need the money. If you're investing for retirement in your 20s, you have decades. That long runway means you can afford to take on a bit more risk for potentially higher growth because you have plenty of time to ride out any bumps in the road. And finally, there's risk tolerance. This one's personal. It's a gut check. How would you feel if you saw your investment drop by 20%? Would you panic and sell, or would you hang on? There's no right answer, but you have to be honest with yourself. Finding a balance that lets you sleep at night is absolutely key. This chart breaks it all down perfectly. Think of it like a sports team. Stocks are your offense. They're there to score points and drive growth. Bonds, they're your defense, bringing stability to the team. And cash is your safety net on the sidelines, ready for short-term needs and emergencies. A good portfolio uses all 3 to create that perfect balance. Okay, so we have our blueprint. Now let's look at the tools in the Modern Investor's Toolkit. We're going to focus on 2 specific things that have completely revolutionized investing for beginners. First, let's talk about the ETF, or Exchange Traded Fund. Now, that name might sound complicated, but the idea is incredibly simple. Imagine you want to own a tiny piece of the 500 biggest companies in the US. Instead of buying 500 different stocks, you can just buy one share of an S&P 500 ETF. It's like buying a pre-made, diversified portfolio in one click. It's instant diversification. But there's always been a catch, right? What about those huge tech companies where a single share costs hundreds, sometimes thousands of dollars? For a long, long time, if you couldn't afford one whole share, you were just out of luck. It was a massive roadblock. But what if you could invest just $5 in that same expensive stock? Well, today, you can. This one number represents a complete shift in power. The question isn't, can I afford a share anymore? It's, how much do I want to invest? The magic that makes this happen is called fractional shares, and it means exactly what it sounds like. You can buy a fraction, a little piece of one share. This means even the most expensive, sought-after stocks in the world are now accessible to everyone, even if you're just starting with a few bucks. It's a total game changer. All right, that's enough theory. Let's get down to business. This is your action plan. We're moving from the what and why to the how-to. This is your step-by-step guide to actually putting that first $100, $500, or $1,000 to work. Here it is, 4 simple steps. 1, open an account. There are tons of great beginner-friendly options out there. 2, put some money in it. Whatever amount you're starting with is perfect. 3, choose a simple, diversified mix of those ETFs we talked about. And 4, and this is the secret sauce, really, put it on autopilot. Set up a recurring deposit. Consistency is what turns small acorns into giant oak trees over time. So what does one of these simple portfolios actually look like? Well, here is a classic, super effective setup called a three-fund portfolio. You'd put most of it, say 70%, in a US total market ETF. Then about 20% goes into a bond ETF for stability, and the last 10% into an international ETF, so all your eggs aren't in one country's basket. And thanks to fractional shares, you can build this exact portfolio with $1,000 or $100 or even $20. Now you've got your money ready to go. So what do? Do you invest it all at once? That's called a lump sum. And historically, because the market generally goes up, that strategy actually wins about 2/3 of the time. But there's another way, dollar cost averaging, where you invest smaller amounts over time. This is less about pure numbers and more about psychology. It helps you get over that fear of investing everything right before a big dip. It helps you sleep at night. Okay, you have the blueprint, you have the tools, you have the action plan. But there's one last piece of the puzzle, and it might be the most important, your own mindset. In this last section, we're going to talk about the common beginner traps, the emotional hurdles that can totally wreck even the best laid plans. Let's look at a real-life example of the emotional roller coaster. So, an investor takes a flyer on a risky stock and it pays off. They make a quick 20% gain. The feeling, wow, this is easy. I'm a genius. And that feeling of overconfidence, it's dangerous. It can trick you into thinking you can't lose. And then what goes up often comes down. The same investor takes a big loss on another risky bet. Now the feeling is, investing is terrible. I'm never doing that again. See the whiplash? The key is to understand that both the winning feeling and the losing feeling are temporary. The real journey is the long road in the middle. So let's just spell out the biggest mistakes to avoid. 1. Chasing hype. If everyone's screaming about a hot stock online, you're probably too late. 2. Checking your portfolio every single day. All that does is stress you out and tempt you to make emotional decisions. 3. Letting fear and greed be your pilots. Stick to your plan. And 4, and this is a huge one, never, ever invest money you might need in the next few years, like your emergency fund. That's a cardinal sin. I think this quote just says it all. Experienced investors know that stock returns should be measured in years, not days. That is the mindset shift. You have to go from thinking like a gambler to thinking like an owner. You're not trying to get rich by next Tuesday, you're playing the long game. So, look, we've covered the why, the what, and the how. We've seen that the old walls have come down, the tools are powerful, and they're available to literally everyone. You have everything you need to start building your financial future right now. The only question left is the one you see on the screen. What's your first step?